When looking for a property for rental property investing, there can be too many options. The goal of this video is to analyze a real estate deal so you can make the best investment for yourself. I know math is not the favorite subject for most people, but it is important to understand the numbers if you want to be successful in real estate. Two of the most important factors to look at when analyzing a rental property are cash flow and appreciation. In this video, I will focus mostly on cash flow. Cash flow is simply the amount of income left when all your expenses have been paid off. That is, income minus expenses. For a rental property, your income is simply the rent you're getting every month. When analyzing a potential rental property, how do you approximate the income that is going to be coming in? Well, the key to calculating income is knowing the fair market rent. There are several ways to do that. First is you go to Zillow.com and see how much other properties in the same area and the same size as your property are listed for. This is by far the simplest way to get a rough idea of what your property could rent for. Secondly, you could also look at local papers or check out Craigslist to get an idea. If you're working with a real estate agent, and I recommend that you do, then your agent should be able to run a comparable market scan and give you an average of what your property could rent for. Here's an example of a comparable market scan that my realtor ran for me. She compared the property that I was looking to acquire with similar properties in the same area. Over here you can see what other properties rented for. This gave me an accurate estimate of what my property could have rented for. Say you come up with a number and your property will rent for $1,200 a month. Now we have one part of the equation solved. What about the expenses? Well, this is a tricky one. Estimating the expenses for a rental property can be deceptive. When a new rental property investor thinks of expenses, they think directly of mortgage, but there's a lot more to it. You see, you forgot about expenses such as taxes, insurance, vacancy periods, repair, lawn care, and so on. Write down all these expenses to determine how much that computes to every month. For example, taxes will say $100 a month, house insurance $55 a month, vacancy, well, your property will not always rent out right away. You may have to sit on it for a week, maybe 2 months. I usually use a vacancy rate of 5% of the monthly rent. In this case, our property is renting for $1,000, so 5% of that is $50. Water, we'll say the tenant will pay for it, so nothing out of the pocket. Same with sewer, and so on. Now right here you can see that I put down $150 per month for capital expenditures. Let's break this down even further. Capital expenditures, also called CapEx, are the big ticket items that need to be replaced not every month or every year, but maybe every 5 years or 10 years. An example of a big ticket item includes roofing, water heater, appliances, plumbing, and so on. These are items that will need maintenance in the long run. Here's an example. You can see how I wrote down all possible CapEx and calculated the cost per year and then the cost per month. Let's say the total cost of plumbing in the next 30 years is $3,000. That means every year that would equate to $100, and every month that would be $8.33. We run the approximate numbers and come up with a nice round figure of $150 for CapEx. If we put all numbers together, our monthly expenses will average about $500. I'm using a nice round figure here for simplicity. Basically, you add all the expenses together. But wait, we forgot our biggest expense, the mortgage. How do you calculate the mortgage on a listing? Very easy. Don't do the math in your head. Instead, go to an online calculator. And to use this calculator, you will need to know the price of the property, the interest rate on the mortgage, and the term of the loan. There are many calculators online just like this one. All you have to do is Google mortgage payment calculators. For simplicity, we'll say the mortgage of your new rental is $550 a month. Let's put all of this together now. What are the total expenses? Mortgage plus the expenses that we calculated equals $1,050. These are all our monthly expenses if we were to rent out this unit. Remember we said towards the beginning of the video that cash flow equals income minus expenses. We figured out the first part of the equation in the beginning of the video. $1,200 our rent, which is the income, minus $1,050, which are the total expenses, equals $150. This is the monthly cash flow. Then the yearly cash flow is 150 times 12, which is $1,800. Is $150 a month of cash flow good enough for all this work? Well, that is for you to decide. One way to look at this return on investment is by doing a cash-on-cash ROI calculation. Cash-on-cash ROI is a simple metric that tells us the yield our money is making based on the cash flow. Cash-on-cash ROI equals total annual cash flow, and you divide that by the total investment. We know the annual cash flow. What about the total investment? Total investment is the total down payment you made to buy the house plus all the closing costs and any repair costs there might be. In this example, I will use $20,000 and we plug all this in the formula. Cash on cash ROI equals $1,800 and you divide that by 20,000 equals 9%. To put this 9% yield into perspective, the stock market's average return over the years is 7 to 8%. So a cash on cash ROI of 9% is not bad. Personally, I would like to see this number a little higher, but again, this is for you to decide. But 9% is not terrible. There are properties out there that will yield even higher. And this is the basics of how I would analyze a real estate property that I want to rent out. But your success in real estate depends heavily on understanding the numbers correctly because numbers don't lie.